Have you ever wondered how to diversify your investments? Asset allocation might be the answer. Imagine your investment as a pie, divided into different slices. Each slice represents a different type of investment or asset class. These can include stocks, bonds, and cash equivalents, among others. The size of each slice, or how much of your money goes into each type of investment, is determined by asset allocation. The real beauty of asset allocation lies in its ability to reduce risk. You see, different assets react differently to economic events. For example, when stocks are having a rough day, bonds might be performing well. So, by spreading your investments across different asset classes, you're essentially putting your eggs in different baskets. This diversification can help protect your investments from major losses. So, asset allocation is your first step towards a more secure and diversified investment portfolio. Before you start diversifying, you need to understand your risk tolerance. But what does that mean? Risk tolerance is essentially your capacity to endure potential financial losses. It's a measure of how much financial risk you can comfortably take on. Think of it like this. If the stock market took a tumble, would you be able to sleep at night? Understanding this concept is paramount, as it directly influences your investment goals and the allocation of your assets. If you're someone with high risk tolerance, you might lean towards an aggressive asset allocation, investing more heavily in stocks which, while volatile, can offer higher potential returns. On the flip side, if you're more risk-averse, you'd probably prefer a more conservative allocation, leaning towards bonds and cash equivalents that provide more stability, albeit with potentially lower returns. In essence, your asset allocation should mirror your willingness and ability to stomach risk. Knowing your risk tolerance is key to determining your asset allocation. Asset allocation isn't about quick wins, it's a long-term strategy. Why is that? Well, let's consider the nature of the financial market. It's a place of constant ebb and flow, with prices of assets rising and falling in response to a myriad of factors, from economic indicators to political events. Now, if you're constantly shifting your investments based on these short-term fluctuations, you might find yourself on a wild rollercoaster ride, one that could potentially lead to significant losses. Asset allocation, on the other hand, is about setting a course and sticking to it. It's about creating a portfolio that's diversified across different asset classes, a portfolio that can weather these market fluctuations over time. This doesn't mean you're immune to losses. Rather, it means that your investments are spread out in such a way that the gains from some assets can offset the losses from others. Think of it as sailing a ship. You don't change course with every wave. Instead, you set a direction based on your destination and you stick to it, making minor adjustments as necessary to navigate the changing seas. The same principle applies to asset allocation. It's not about timing the market or chasing after the latest hot stock. It's about creating a balanced and diversified portfolio that aligns with your long-term financial goals and risk tolerance. Remember, asset allocation is a marathon, not a sprint. You've set your asset allocation, but the work doesn't stop there. You need to rebalance your portfolio. But what does rebalancing mean and why is it important? Picture this. You've carefully crafted your investment portfolio, allocating assets in a way that aligns with your risk tolerance and long-term goals. But over time, as the market ebbs and flows, your original asset allocation may drift. This is where rebalancing steps in. Rebalancing is the process of realigning the weightings of your portfolio of assets. It involves periodically buying or selling assets in your portfolio to maintain your original desired level of asset allocation. For example, if you initially planned for a 50-50 split between stocks and bonds, and your stocks have performed particularly well, you might find yourself with a 60-40 split instead. To rebalance, you would sell some stocks and buy some bonds to get back to your 50-50 target. But why is this necessary? Well, let's go back to our example. If your stocks are now making up 60% of your portfolio, you're taking on more risk than you initially planned for. Rebalancing helps ensure you're not unintentionally drifting into a riskier investment strategy. Rebalancing also offers a systematic approach to buy low and sell high, one of the golden rules of investing. When you rebalance, you're often selling assets that have performed well and hence are high, and buying more of those that haven't and are low. Rebalancing is like fine-tuning your investment machine to keep it running smoothly. Scene script. Asset allocation can seem complicated, but you don't have to do it alone. Professional advice can be invaluable. In the complex world of finance, even the most seasoned investors sometimes need a guiding hand. This is where professional advice comes into play. Financial advisors or investment professionals dedicate their careers to understanding the nuances of the market, and they can provide the expertise you need to navigate through the maze of asset allocation. Think of financial advisors as your personal finance navigators. They can help map out your investment journey, taking into account your personal financial situation, your goals, and your risk tolerance. Each of these factors is unique to you, making your asset allocation strategy equally unique. Your financial situation sets the stage. It's the starting point. A financial advisor can review your income, expenses, savings, and liabilities to get a clear picture of your current financial health. This step is crucial as it lays the foundation for your asset allocation strategy. Next, they consider your goals. Are you saving for a comfortable retirement? Perhaps you're planning for your child's college education, or maybe you're working towards purchasing your dream home. Whatever your goals may be, a financial advisor can help align your asset allocation with these objectives. Risk tolerance is another crucial factor. How much market volatility can you stomach? Are you comfortable with taking on high-risk investments for potentially higher returns? Or do you prefer a more conservative approach? A financial advisor can help you gauge your risk tolerance and ensure your asset allocation aligns with it. In essence, a financial advisor or investment professional can provide a tailored approach, helping you determine an appropriate asset allocation strategy. They can offer insights, clarify doubts, and even provide emotional support during volatile market periods. So, even though asset allocation might seem like a daunting task, remember, you don't have to do it alone. There are professionals who can guide you through it, helping you make informed decisions that align with your unique financial situation, goals, and risk tolerance. Remember, asset allocation is a critical part of investment diversification. But with the right knowledge and possibly some professional guidance, you can make it work for you.